Bitcoin dipping to around 91K feels like that moment when you check your wallet and realize the cash you thought you had was actually just old receipts. It's uncomfortable, I get it. I literally refreshed my price app so many times yesterday my phone asked if I was okay. But here's the weird part. Beneath the panic, the structural stuff looks better than ever. Big regulators finally stopped arguing, ETFs have opened the door for institutions to stroll in confidently, exchange supply is drying up like we're in the Sahara, and central banks are quietly shifting back toward liquidity. So this drop doesn't look like doom. It looks like a temporary discount window where the big money is loading the cart while pretending they're just browsing. Like, subscribe, and watch till the very end, because in this video, I'll be breaking down what happened, the 4 market catalysts providing this opportunity, data signals to watch, and the way forward.
The week started like any other, checking the charts, thinking, maybe another boring Monday. And then Bitcoin decided to drop nearly 30% from its October all-time high of around 126K, crashing back down to the 91K zone. If you were new to crypto, your heart probably skipped a few beats, maybe even spilled your latte. I've been through these dips enough to have that déjà vu feeling, like a bad sequel you didn't ask for. But here's the thing, as the dust settled, a pattern became obvious. This wasn't a collapse caused by fundamentals. The technology is fine, adoption is growing, and institutions aren't fleeing. No, the chaos came from the plumbing underneath the market misfiring. Leverage-heavy retail positions collapsed first, creating a domino effect of liquidations. Exchanges and market makers strained under the sudden stress. I mean, it looked like watching someone try to juggle chainsaws while blindfolded.
And here's the kicker, these weren't long-term institutions exiting, these were short-term players tripping over their own leverage. The whales weren't panicking, the dolphins were just calmly adding to their bags. When a sell-off is driven by structural quirks rather than true conviction, the story flips on its head. What feels like disaster to the crowd is actually a rare tactical setup for patient, regulated capital to quietly accumulate without causing a spectacle. So while the headlines screamed bloodbath, savvy eyes were already scanning the order books and cold wallets, and that's where the real story begins, the kind of story you look back on and say, that's the dip I wish I'd bought. So why does 91K, a number that had most of us gripping our keyboards in terror, suddenly feel more like a clearance sticker at your favorite electronics store? The truth is, 4 structural forces quietly shifted the entire game behind the scenes, and if you blinked, you might have missed it. A. Institutions finally have plug-and-play access. Flashback a few years, a pension fund wanted Bitcoin, and suddenly they were in a jungle of custody policies, counterparty checks, hardware wallets, and legal headaches. It was like asking your grandma to program a drone. Today, ETFs flip the table. Institutions can now buy Bitcoin and Ethereum through the same terminals they use for stocks. No hardware wallets, no operational chaos. The friction is gone. The question is no longer can we, it's should we. With ETF AUM exploding, the marginal buyer in 2025 isn't a retail trader refreshing Binance every 2 minutes, it's regulated giants with patient, deep-pocketed money. B. Regulation turned fog into roadmap. As ETF rails matured, so did the legal landscape. Europe rolled out MiCA, the U.S. agencies offered guidance, and compliance teams finally had something resembling a playbook instead of constant red alerts. Once legal tail risk becomes measurable, institutional allocators stop calling crypto uninvestable and start modeling it like any other asset class. Clarity doesn't create demand, it unlocks it. C. Exchange supply is quietly vanishing. Meanwhile, coins are quietly leaving exchanges for cold storage. Historically, this is a conviction signal, not panic. Lower on-exchange supply means fewer coins available to dump at the first hint of fear, tightening the spring even if demand is flat. On-chain data shows accumulation, not distribution. This is the footprint long-term patient buyers leave behind while the headlines scream. D. Macro liquidity is about to flip. Here's the macro twist. The Fed is preparing to end quantitative tightening. When QT dies, liquidity returns, and risk assets historically re-rate upward in those windows. Combine renewed liquidity with ETF rails and low exchange supply, and suddenly 91K doesn't look like a breakdown. It looks like asymmetric upside waiting for buyers to step in. Each of these forces is powerful alone. Together, they turn what felt like a crash into a rare tactical setup.
A good story still needs proof. Here's what I watch. ETF net flows. Institutions vote with flows, not tweets. Exchange reserves. Falling balances equals drying supply. On-chain cohort behavior. Are institutions quietly stacking while retail panics? Macro liquidity indicators.
Fed balance sheet, QT schedule, real yields. Open interest and derivative skew, shows where blowups and bounces are hiding. These aren't headlines. These are the heartbeat of the market, the signals that separate panic from opportunity. So here's the thing. Analysts are all over the map on timing. Some are yelling bottom is in, while others are nervously sipping their coffee, muttering, maybe we retest lower? But almost everyone agrees on one critical point. Institutional demand isn't dead. It's just napping. Think about it like this. Crypto is that friend who swears they'll hit the gym, then disappears for 3 months. You know they're going to show up eventually. The only question is when. Historically, late November through December has been a wild card, giving markets unexpected rebounds that catch the casual crowd completely off guard. Remember last year? Bitcoin pulled off a mini miracle right around Thanksgiving. Even mainstream media has been quick to highlight how Bitcoin reclaimed 91K so fast, faster than I could finish my morning coffee. But if you zoom out, it's not a fluke. ETF trackers earlier this year reported record demand, proving institutional appetite isn't a rumor. It's very real, very patient, and very strategic. The tricky part? Unlike retail traders glued to charts and Discord chats, institutions move methodically. They don't panic sell after a tweet storm, and they don't rush in just because a headline says Bitcoin crashes. Their timing is tactical, based on liquidity, regulatory comfort, and operational readiness. So yes, while everyone argues over the exact timing, some expect 100K plus, some expect sideways chop, the bigger story is this: the money is ready, it's just waiting for the right setup. And when it finally wakes up, you might look back and realize that 91K was more than just a dip. It was the quiet, tactical opportunity that everyone either missed or ignored while panicking at the charts. Of course, let's be honest, this path isn't guaranteed. Nothing ever is in crypto. First, macro conditions could flip faster than a pancake on a Sunday morning. One hawkish Fed comment and what looked like a tactical window could turn into a short-term roller coaster nobody asked for. Then there's the invisible hand of algorithmic rebalancers. You know, those automated systems that scream panic faster than a Twitter mob. Even if all the fundamentals line up, these algos can whip the market around intraday, creating moves that feel like someone hit shuffle on a roller coaster playlist. Regulatory surprises are another wild card. Just because Europe and the U.S. laid down the law doesn't mean new twists aren't lurking in tax codes, enforcement decisions, or international policy shifts. A single headline can spook traders, even when the structural story is solid. And low exchange balances. Sure, coins leaving exchanges look great on chain, but that doesn't guarantee buyers will actually show up at the right moment. Supply can tighten, but demand still has to pull the trigger. Here's the key. A good investment thesis survives stress testing. If it crumbles at the first sign of volatility, it wasn't much of a thesis to begin with. The current setup, ETFs, institutional readiness, regulatory clarity, dwindling supply, and a macro pivot, still holds up when you throw stress at it. It's not flawless, and it won't be smooth, but it's resilient. So yes, there are risks, plenty of them, and anyone ignoring them is probably the same person who tried to time Dogecoin with a magic 8-ball. But a thesis that survives scrutiny, that's the one that can turn a scary 91K dip into something much more interesting, if you're patient enough to watch it unfold. Alright, let's talk about the future, the one nobody can predict but everyone loves to guess. Picture it like this. Bitcoin at 91K isn't just a number, it's a crossroads. And at this crossroads, there are 3 very different roads you could end up walking down. Strap in. Road A, structural accumulation, measured rebound. This is the boring genius scenario. Institutions start buying again, slowly but surely. ETFs keep flowing, coins stay off exchanges, and the price begins to normalize over the next few months. It doesn't have to spike to the moon overnight, it just creeps back toward levels that make long-term holders smile in their sleep. Think of it as the slow-motion recovery, like when you spill coffee on your shirt but it dries clean and no one notices. This path rewards patience and process. Road B, sideways chop with violent squeezes. The classic crypto keeps you on your toes scenario. There's plenty of money in the system, but flows aren't coordinated. One day, Bitcoin pops 5K, the next it drops 7K, like watching a toddler with a sugar rush on a seesaw. The price grinds sideways, lulls you into thinking nothing's happening, then bam! A short squeeze or algorithmic rebalancer shakes the room. This path tests nerves and position sizing. Traders will have fun, long-term allocators will grit their teeth. Either way, it's noisy, and noise is the friend of panic and the enemy of conviction. Road C, macro shock and deeper retest.
Now for the hair-on-fire scenario. A hawkish pivot from the Fed, a geopolitical curveball, or some unexpected policy shock could shove Bitcoin lower, maybe even down to the 50 to 70K zone. It's the scenario that makes headlines scream, crypto Twitter rage, and late-night panic calls to your broker inevitable. But here's the kicker. While scary, this is a lower probability path, not impossible, and historically, these shakes have been temporary if the structural story holds. None of these outcomes are certainties. Crypto doesn't work that way. But understanding the distribution of probabilities matters. It helps you plan, hedge, and importantly, avoid turning knee-jerk fear into permanent regret. So here's my take. Watch the data, respect the volatility, and remember that 91K could be either a tactical entry, a sideways grind, or a stress test. The road isn't clear, the signposts keep moving, but knowing the map gives you a serious edge. And if you're lucky, you'll laugh at the chaos, preferably after you've stacked a few more coins.
All right, let's wrap this up with some real talk, and I mean practical, boots-on-the-ground takeaways. Not financial advice, mind you. I'm not your broker, and neither is anyone on crypto Twitter, but some observations from years of staring at charts, watching whale flows, and spilling more coffee than I'd like to admit while refreshing exchange balances at 3 a.m. First, for the long-term believers. If you're in this game for the decade, not the day, the strategy is simple. Dollar cost average. ETFs, direct custody, your preferred method, pick a reliable rail and stick to it. Ignore the siren calls of Twitter panic, FUD headlines, and those TikTok videos promising the moon overnight. Remember November 2025? Bitcoin dipped to 91K and every Reddit thread felt like the end of the world. Yet here we are, still ticking along. The lesson? Volatility is a feature, not a bug, if your horizon is measured in years, not minutes.
Next, the institutional crowd. Listen, the excuses are gone. MiCA U.S. guidance, ETF rails, the operational friction that once scared you off is cleared. Now it's about process. Custody, insurance, compliance memos, board approvals. Build the checklists now. Don't wait for the next dip to panic start procedures. The capital that moves with patience and precision wins. And trust me, watching a well-oiled institution slowly accumulate while the crowd panics is more satisfying than any market rally highlight reel. For the traders in the room, respect the game. Leverage is a double-edged sword. It can amplify gains but destroy accounts faster than a surprise Bitcoin drop at 2 a.m. Respect liquidity and open interest. Know where squeezes can happen. Use protective sizing and never forget that a liquid market can vanish in a heartbeat during correlated rebalancing or algorithmic chaos. Some days you'll make the right call. Other days, the market will remind you who's boss. The common thread here? This market rewards discipline, not bravado. Showing up with a plan, respecting rules, and executing consistently beats trying to outsmart every candle. Think of it like cooking a perfect souffle. Follow the recipe, measure carefully, and don't panic if it wobbles a bit. The payoff comes over time. So whether you're stacking for the next decade, designing an institutional playbook, or trading the chop, focus on structure, patience, and preparation. Ignore the noise, respect the mechanics, and let the market do its thing. If you can do that, you're not just surviving crypto, you're positioning to thrive when the next leg of this story unfolds. 91K isn't just a price tag, it's the meeting point of 4 converging structural forces. Regulation matured, institutional rails hardened, exchange supply tightened, macro liquidity is turning. History rarely gifts the same setup twice. This dip may one day be remembered not for its fear, but for the capacity it gave institutions to quietly accumulate while retail panicked. What part of this video resonates with you? Share your opinions in the comments section. This is Blockchain Money.